And one last strategy I'd like to look at is the stock spread strategy. And this is kind of like the market neutral strategy for a call option purchase. And in this case, if we have a stock purchase, we also want to protect profits in a stock purchase. So we use Prime Trade Select to select stock trades. That's done very well over the years. It's produced a lot of profitable stock trades. And if you have a winning stock trade, again, you're facing that winning trade dilemma, and you got to decide whether you're going to hold that stock in case the stock keeps going up, or take profits in case the stock declines, with the possibility of your trade turning into a loss. So that's a good dilemma to have. So whenever you have a profit in a stock, and we'll normally initiate these stock spreads if we have a 10 to 15% profit in a stock, we'll want to lock in that profit by buying a put option. So this is very similar to the market neutral strategy. And in this case, we own a stock and we have a profit in a stock. We want to protect that profit, so we simply buy a put option on our stock trade. So this is also known as a married put, and that, of course, solves that winning trade dilemma, because you're holding your stock, and if it continues to go up in price, then of course you're going to continue to profit. But at the same time, you buy a put option, and that protects the profits in the stock in case the stock declines in price. So what we do is, if we have a profitable stock trade, we always want to protect those profits by buying an at-the-money put option. And it's possible that you can, when you buy that put option, that you can even guarantee a profit for your stock trade. So, and when you buy that put, it doesn't limit the upside potential if the stock continues to increase in price. And another advantage of the married put strategy is any dividends that you receive on your stock, that can help pay for the cost of the put option. So that's also a very low risk strategy. You buy the dividend paying stock, the dividends help pay for the put option, and that really reduces your risk for trading stocks. So with a married put, you create it by purchasing 100 shares of stock and purchasing one put option, and the put option can be purchased simultaneously, or you can leg into the spread if you have an existing profit on your stock. We normally leg into these spreads when we have a profit in a stock to protect those profits. And I actually trade these in my retirement accounts. So the put option, when you buy that put option, of course, it limits your risk, and the put option acts as a floor for the value of the stock, and at the same time, your profit is not limited or capped. So let's look at an example. This is for the FAS, and I bought 200 shares of the FAS at 106.50. FAS then had a 3-for-1 stock split, so the split adjusted price for the 600 shares was $35.50. So bought 200 shares at 106.50, and then after the stock split, I had 600 shares at a cost of $35.50. So had a profit in this FAS, and bought to open the 70 strike put at $5.90. Now that created the married put spread, and by buying that put option, I locked in the profits for the trade. And at the same time, it didn't limit my upside potential if FAS continued to move up in price. So again, bought the, you can see here, bought 200 shares, FAS 106.50. They had the 3-for-1 stock split. I had a profit in the stock, so then I bought the FAS 70 strike put at $5.90. So we have a married put calculator, and that will calculate the profit potential for the married put based on various price changes in the underlying stock, in this case from 150% increase to a 100% decrease in the stock price. And I didn't calculate in the entry date or exit date because it doesn't pay a quarterly dividend. So if you have a dividend paying stock, then you'd want to enter the entry date and exit date, and then it'll calculate the dividends you received over that period, and that it'll take that into account on the profit potential for the trade. So in this case, we didn't fill that in because the FAS wasn't paying a dividend. So again, we paid $35.50 for the stock. We bought the 70 strike put at $5.90. So let's look at the risk potential and profit potential on this trade, and we can see that if FAS is flat at $35.50 at option expiration, then we'll have a 72% return. So, and if FAS stock goes down, we wouldn't expect it to go down this much, but if it did go down, you still lock in a profit. So basically, by buying that put option, we locked in a 72% return for the FAS ETF. And if the stock continues to go up, there's no limit on the profit potential if the stock goes up. Here's one more example. This is for TNA. That's the small cap ETF. Bought 200 shares at $52.84, and it had a 2-for-1 split. So the adjusted price for 400 shares was $52.84. We wanted to lock in the profit, so we bought the 55 strike puts at $5.50, and that created a married put trade. And here's the profit loss potential for this trade. And again, we paid $26.42, split adjusted, bought the 55 strike put at $5.50. So if TNA is flat at option expiration, we have a 72% profit on the spread trade. And if it goes down, we locked in the profit at 72%. So this is a way to protect our profits. So whenever we have a profitable stock trade, we create a married put, or we sell a call option and create a covered call. So for our profitable stock trades, we either create a married put or a covered call. And for our profitable option trades, we either create a debit spread or a market neutral spread. So these strategies have all been working well in the current market environment, and we continue to trade those. So with the married puts strategy, once you buy the put option for protection, then you can forget about your stock trade until expiration. You don't have to worry about putting in a protective stop or severe market declines because you're already protected with that put option protection. So bad earning reports don't matter. A severe sell-off doesn't matter. So you're protected. Okay, that concludes my presentation for today. And if you're interested in the strategies just presented, then you can log on to chuckhughesic.com, or you can call Brad toll free at 866-661-5664, or 310-647-5664. So if you're interested in the strategies, just log on to the website or call Brad. So that
Chuck,
concludes my
why don't we leave that up for a minute, Chuck? Why don't we leave that up for a minute so people can write that down? We have a slew of questions, and what I'm going to do, Chuck, is the ones that we have a half a dozen of the same question, I'll try to word it the same way so we can get through with this. You said that you use the Keltner channels. Can you use the Keltner channels with ETFs as well?
Yes, that's a good question. Yes, the Keltner channels are available for ETFs as well. And of course, the Keltner channels just track the daily price movement over the last 20 days, and that's how the channel is created. So yes, you will get the Keltner channels for ETFs.
Regarding your selection of picks, Chuck, where do you start looking for potential trades?
Okay, that's a good question too. And what we do is we look at the new 52-week high list every day, and when we see a stock that starts showing up on that new 52-week high list, let's say Amazon or Google, if it makes a new 52-week high, then we put that on our list, and those are usually the best candidates for these bullish trades, whether it's a call option purchase or a call option spread trade. If we're looking to put on a bullish trade, we look at the 52-week high. And during the bear markets, of course, we look at the new 52-week lows. So that's where we start our search. We look at that 52-week high list. We write down those stocks that are making new 52-week high, and then we wait for a retracement with the Keltner channels to that middle or lower channel, and that's when we pull the trigger and enter a trade.
Eric S. has asked, with the volatility that we're seeing in the markets, for whatever reason that may be, are you finding that a lot of the bid and the asks are becoming wider than usual? Have you noticed any type of trends there, Chuck?
No, that's a good question. We normally just trade the very liquid stocks and that have over 1 million shares traded every day. And when you do that, they have fairly tight bid-ask spreads on the options. And usually it can be anywhere from 5 to 10 to 20, 30 cents on the bid-ask spread, which brings up another good question. In order to mitigate, that bid-ask spread, we'll use limit orders when we enter an option trade, whether we're buying or selling an option. We will use a limit order, usually halfway between the bid and ask price, and we can normally get filled in that area. So if you're concerned about buying an option or selling an option in an illiquid stock or ETF, then you definitely want to use a limit order to mitigate the cost of the bid-ask spread.
Chuck, Wendy Elise is asking if you could utilize the delta neutral trade strategy for options on futures.
Okay, so that's the market neutral strategy I think she's talking about, and you could use that on futures. And I've used it before on the stock index futures options. In other words, like on the NASDAQ 100, there's options traded on the NASDAQ 100 futures contract as well as the S&P. So you could trade either debit spreads or market neutral spreads with those stock index futures options. And I've done that many times in the past. And again, when you're trading options, whether they're futures options or stock options, you want to use that limit order to mitigate the bid-ask spread cost.
Chuck, we have so many participants asking about that big free report you're going to hand out to all the attendees today. Can you comment on it real quickly?
Oh yeah. That I developed that over the years, and that's a pretty useful report. And we go into detail on covered calls and option debit spreads and the income that you can create from either selling covered calls or selling debit spreads. And over the years, we've collected millions of dollars in premium income using those strategies. So I go into detail on that report, showing you how to collect this income from covered calls or from option debit spreads.
Well, Chuck, thanks again for putting on an awesome webinar. I got to tell you, you're getting a lot of accolades from your attendees today, and I'm not going to go down the list. I'm sure you could read some of them as they're coming across the tape, but I'm hoping to have you out again soon, Chuck. You are, for those that don't know, Chuck is a great giver of his time. Chuck does not get paid to do these. He does not get endorsements to do these, promotions to do these. He does this because he literally believes he makes a difference when it comes to people trading. So that number on the screen, give it a call. Chuck's support staff's really, really good. They're very handy, and Chuck is very punctual in returning specifics regarding strategy. So, Chuck, I hope I can have you out again next quarter if possible.
Yes, absolutely, Tom. And thank you, Tom, for taking the time to set up this educational webinar. I enjoy doing them and look forward to the next one.
Thanks, Chuck. I appreciate it. Tell the wife and kids we say hello here in Central United States, and we'll be in touch. Stay dry out there on the West Coast. And for everybody that is joining us, thank you very much for your patience. And by all means, we're going to get you out that free report, and we'll send you out some links for the recording here in the archive. Thanks for joining us, everybody. Chuck, we'll talk to you soon, my friend.
Okay, thanks, Tom.
Good night, everybody.
Have a good day, everybody.